All right, we are live. It's Sunday morning, and we are staring down the barrel of the first full trading week of 2026.
The holiday haze is officially over.
It's gone. Liquidity is coming back into the market, and the big institutional desks, well, they've sent out their strategy reports.
Their marching orders for the year.
Exactly. So our mission for you today is to synthesize that entire stack of reports. This is the same intel the pros are using to get you ready for tomorrow's opening bell.
And we're going to break down everything, the key technicals, the positioning, and the very heavy macro calendar.
So if we had to put one word on the sentiment right now, what would it be?
Neutral. Definitely neutral. We're not sprinting into a bull market, but we're also not, collapsing.
It just feels coiled.
Perfectly coiled. I think the key tension here is that you have this technical exhaustion from the massive run-up meeting, just a wall of macro uncertainty.
Okay, let's start with the weekly recap then. How did we close out last year's session?
Well, the S&P 500 had that incredible performance in 2025. What was it, a 16% run?
A record 16% run, yeah. But Friday's close last week, that was a pretty clear signal of a weak rejection. That whole Santa rally idea it hit a wall.
It hit a wall of institutional profit-taking. And the real tell, was the Nasdaq 100.
The star of 2025, it led the retreat, dropping 0.8%. Now, that might not sound like a lot.
No, but that 0.8% dip is the nugget you have to focus on.
Why?
It's the signal that liquidity is back, and the big money is doing that classic New Year reset.
So this isn't panic.
Not at all. It's calculated rebalancing. Desks are taking profits off those huge, overextended tech winners from last year, and getting positioned for what they see as the next big theme.
Okay, let's unpack that new theme because this feels like the biggest narrative shift we've seen in a while.
It is.
We're moving on from the inflation fear trade. The new buzzword in all these reports is the productivity paradox.
This is the engine of the soft landing 2.0 thesis. It's a huge idea we need to really spend some time on.
So what's the core paradox here?
It's the contradiction in the data. You have unemployment, which is, slowly creeping up towards 4.6%.
Historically, that's a recession signal, a demand collapse.
Right. But at the same time, U.S. GDP is still remarkably resilient. It's printing at 4.3%.
And in a normal cycle, those two numbers can't live that far apart. If jobs are softening, growth should be softening much faster.
Exactly. So the market's answer to that question, why is this time different, is technology, specifically AI.
So this soft landing 2.0 trade is built on the idea that AI-driven efficiency is finally boosting corporate margins.
Yes, it's acting like a structural buffer against recession. The idea is that companies can maintain or even improve profitability without having to hire more people. They might even be shedding labor.
Which means slow job growth, which used to be universally bad news,
Is now Goldilocks news for stock multiples.
because it lets the Fed cut rates since demand pressure is easing, but corporate profits stay resilient because of that efficiency.
Precisely. Bad news for the worker becomes great news for the market. It fundamentally changes how we have to look at the jobs data coming this Friday.
But here's the strategic question. Institutions are really hanging their hat on this. Historically, though, this kind of divergence between GDP and unemployment, it collapses fast. What makes them so sure that AI is a permanent buffer this time and not just, some temporary noise?
Well, that is the billion-dollar question, isn't it? The confidence comes from this belief that the efficiency gains are structural, that they're permanent.
Unlike a typical cyclical bounce.
Exactly. But if this week's data, especially the PMIs, shows that margins are not improving and that GDP is actually getting revised lower,
The whole thesis evaporates.
instantly. And that's the worst-case scenario, weak labor and weak productivity. And that's why the market is just holding its breath right now.
Okay, that sets the macro stage perfectly. Let's drill down to the charts because the technicals have to support the story. And right now, the reports are calling this technical purgatory.
That's a great term for it.
The trend is up, but the ceiling just feels incredibly heavy. I want you to give our listener the key levels they have to watch tomorrow morning.
Yeah, technical purgatory is like revving an engine on a steep hill, but the tires just aren't getting traction. The momentum is stalling right at major resistance.
So let's start with the S&P 500, SPX.
Okay, SPX closed Friday at 6,858. Now, that was a small win for the bulls.
Because it defended that 20-day moving average.
It did. It held 6,856, which is that immediate support line. So check one for the bulls.
But that heavyweight overhead is what's scaring everyone.
It is. The SPX is bumping its head hard against the 7,000 Great Wall.
And that's not just a random round number.
No, it's a huge technical level. 7,000 is the precise upper boundary of a 5-year parallel bull channel.
So if we can't clear it,
It confirms the multi-year rally is hitting a structural ceiling. But the real high-stakes level, the pivot you have to watch, is 6,800.
and a break below 6,800 means what?
It invalidates the entire Q4 breakout. And it puts serious pressure on that buy-the-dip muscle memory that defined 2025.
Right. What about the Nasdaq 100, the NDX? It seems to be straining a bit more.
It is. It closed at 25,206, and it is just clinging to the ascending support line of its 2025 bull channel.
What's the tactical break point there? What's the line in the sand?
The decisive pivot for the NDX is a nice round 25,000.
Okay.
If we break and hold below 25,000, the whole technical narrative shifts. It goes from accumulation, where desks are still buying, to distribution.
Meaning they're actively selling into rallies.
Actively selling. And if that happens, the AI 1.0 vertical run is over.
But here's the thing that every single source agrees on. Forget the indices for a second.
Yeah.
All roads lead to one chart. The one chart that dictates everything this week.
The 10-year Treasury yield, the US 10Y.
It ended the week at 4.19%.
That's the battleground.
Yeah.
That 4.19% close puts the yield right on the verge of testing that multi-month resistance at 4.20%.
So this is where the bond market decides if it buys into the soft landing 2.0 story.
Exactly. If the yield breaks and sustains a move above 4.20%, the next target is 4.50%.
And a surge to 4.5% would just crush the equity risk premium.
It squeezes it hard. It makes high-duration tech stocks instantly unattractive. I'm telling you, this yield chart is the only one that really matters for the next 72 hours.
Yeah.
It's the live proxy for what the Fed is going to do next.
Okay, so let's talk conviction. Given this tight setup, this 4.20% overhang, was last week's price action backed by any real money?
The answer is a firm no.
So no conviction.
Absolutely no conviction. Last week was a ghost town move. Trading volume was, 31% below the 30-day average?
So that volatility was just...
It was systematic rebalancing, automated flows, thin retail activity. It was not fresh institutional capital coming in. And when liquidity is that low, these pivot levels are incredibly vulnerable.
vulnerable to a liquidity flush.
A sudden, exaggerated move in either direction if tomorrow's data delivers any kind of shock.
And this leads right into positioning, because the Commitment of Traders report, the COT data, it's painting a picture of a massive divergence.
A glaring split.
Yeah. For our listener, the COT report just tracks how different types of traders are positioned. What's it showing?
Okay, so on one side you have the asset managers. This is this slow, long-term money, right? Pensions, endowments.
Yeah.
They trade the S&P E-minis.
And they are still net long. They believe in the trend.
They're still net long, but on the other side you have the fast money.
The leverage funds, hedge funds.
Exactly. And they are net short nearly 400,000 contracts.
That is a huge bet against the market.
It's an enormous bet. And this crowded short among the speculators, it basically guarantees we're going to see extreme volatility. You have institutional bulls and speculative bears steering each other down at these key technical levels.
So what does that mean for directional risk tomorrow morning? Where is the pain going to be felt the fastest?
The immediate pain trade is clearly to the upside.
To the upside. Explain that.
Well, because the sentiment is so cautious, these leveraged funds have gotten really bold betting on a New Year hangover sell-off.
So that 400,000 contract short position.
It's a gigantic spring loaded on the downside. If any of the early data this week comes in, even just okay, a sudden rally would force those shorts to cover aggressively.
A short squeeze.
A massive short squeeze. And it would act like rocket fuel, launching the market much higher, much faster than the thin volume would normally allow.
And the market's technical health kind of supports that, right? It's not exhausted, it's just coiled.
That's the perfect word for it, coiled. If you look at the RSI extremes, there are only 12 stocks total in the S&P 500. 4 overbought, 8 oversold. We have so much dry tinder for a big move. The path of least resistance, thanks to that positioning, is up. Until proven otherwise.
All right, let's shift to the chaos drivers. The red folder calendar this week is absolutely stacked. It starts tomorrow, Monday, January 5th. ISM Manufacturing PMI at 10 a.m. Eastern.
This is our first big look at industrial health for 2026, and the inflection point is stark.
What are the two scenarios?
If the number comes in hot, say above 51, it validates the soft landing thesis. Stocks should rally.
And if it comes in cold?
If it's cold, below 48, that means the industrial sector is still contracting. Recession fears immediately reignite, and you'll see capital rush into treasuries.
Then Wednesday, January 7th, we get the ISM services PMI and the JOLTS data.
And services are 80% of the U.S. economy. This is the one the Fed really watches.
So if the services PMI comes in hot,
That's the Fed's nightmare. It means services inflation is sticky, and it guarantees they have to stick with higher for longer. Growth stocks, the whole Nasdaq complex, they get hit immediately.
and if it's cold.
A cold print decisively fuels that Goldilocks trade. It pressures the Fed to cut sooner, and that's good for equities broadly.
And then the big one, the undisputed heavyweight champion, Friday, January 9th, 8:30 a.m. Eastern, the December Nonfarm Payrolls report.
NFP, yeah.
Consensus is looking pretty sluggish, around 50,000 jobs.
This report carries so much weight because it's the first truly clean data set we've had since the government shutdown last year. And it's a clear fork in the road.
What's the binary risk?
A hot print, let's say over 200,000 jobs, is aggressively inflationary. The bond market will absolutely breach that 4.20% level on the yield.
And the Nasdaq sells off hard. The good news is bad news scenario.
That's it. And the flip side, a cold print, say, under 100,000 jobs.
Then bad news is bad news.
It confirms the labor market is cracking. The market will panic about a hard landing, and you'll see a broad sell-off. The productivity story can't save you if the labor market is collapsing.
So let's wrap this all up. Let's build the game plan for the week. You mentioned the Nasdaq is extra sensitive. Why are you calling tech a duration trap right now?
It's a classic duration trap. These are assets, like high-growth tech stocks, that rely on cash flows way out in the future.
Which makes them disproportionately sensitive to interest rates.
To the 10-year yield specifically. And since all the data this week, the PMIs, NFP, is putting maximum pressure on that 4.20% yield level, those high-duration names are the riskiest place to be. I wouldn't be chasing tech laggards until the bond market figures itself out.
So the ultimate focus, again and again, it just keeps pointing back to
The 4.2% level on the 10-year Treasury yield, every single thing we've talked about, the short squeeze, the technical levels, the NFP reaction, it all hinges on whether the bond market accepts that higher for longer narrative again this week.
a breach of 4.20% is the risk-off trigger.
It's far more important than anything the S&P or the Nasdaq does on its own.
Okay, stay agile. The market is perfectly coiled. You have speculators leaning heavily short. Institutions are still long. That tension means the coming move will be violent, especially on thin volume. What stands out to you this week is whether the sheer force of the macro calendar, the jobs and services data, is what dictates the direction tomorrow morning, or whether the technical resistance at 7,000 holds firm. You need to stay focused on that yield because the minute it moves, everything else will follow.